Yeah, there we go. Great. So, welcome back, everybody. It's my real pleasure to welcome Johnny Tang, who's a newly minted assistant professor of finance at Cornell, to talk about competition among regulators in the captive life insurance industry. In addition to this paper, he has another work that was presented here by his co-author a couple of years ago on conflict of interest in the sale of variable annuities. So he's doing really interesting work on several aspects of insurance, and I hope you're as eager as I am to hear what he has to say about this important question of sort of regulators and how they compete with each other. So welcome, Johnny. The floor is yours. I will keep the queue. If you want to ask a question, just raise your hand, raise your visual hand, virtual hand, and yeah, I think that's about it. Thanks.
Great, awesome. Well, thank you so much for the introduction. Yeah, very excited to be here. Let me just get my screen shared up and then we can jump right in. Okay, so can everybody see my screen all right? Awesome.
Yep, you're good.
Well, thanks so much again for inviting me. It's a pleasure to be here. I'm Johnny Tang. I'm an assistant professor at Cornell. Here to present my paper on regulatory competition in the U.S. life insurance industry. So let's jump right in. So this project was really motivated from the observation that a lot of regulation is decentralized, but a lot of the regulators, when they regulate different markets, the markets that they regulate tend to span across the jurisdictions of these regulators, right? So let's take a step back beyond insurance. This kind of decentralization often leads to competition between regulators, right? So if you think in the case of international corporate tax policies, for example, countries compete over the corporate tax rates. Think about environmental regulations. There tends to be, colloquially races to the bottom on environmental regulations. So this kind of decentralization of regulation raises the question of whether having competing regulators is a good thing or not, right? So in the words of economics, does it increase total surplus? And there's kind of two opposing views on this. On one hand, you might think that competition between regulators leads to a race to the bottom, which in the presence of externalities can lead to inefficient outcomes, right? A classic example of this is pollution in the case of environmental regulations. But an alternative view, and I think one that's sort of in line with this classic public finance literature on federalism and fiscal federalism, is that competition could potentially be beneficial in that it potentially helps discipline overly strict regulators or allows the markets to vote with their feet, right? And this is kind of expressed in the works of Thibault and other classic public finance literatures. So in addition to kind of thinking about this, the directional effects of regulatory competition, there's also a question of its quantitative effects, right? So how much of a race to the bottom there is really, and how much do they affect the outcomes in different markets that the regulators are competing over. And one challenge, if you think about sort of these international tax or environmental regulation settings, is that it's often very hard to measure these different forces, right? It's very hard to actually correctly measure the amount of pollution that one factory in one country maybe is emitting towards other countries. So what this paper is going to do is it's going to study this issue of regulatory competition in the context of the US life insurance industry. And one advantage, as I'm sure you all know, of the life insurance industry is that it contains detailed data that allows us to measure the different forces and externalities that are present in regulatory competition in the US life insurance industry. So just to summarize the kind of competition that I'm studying, in the US, regulators are operating at the state level, and these state insurance regulators compete for insurance companies to be regulated by their states. And what I mean by this is that the regulators compete for insurance companies to set up captives or subsidiaries in their states, and they compete in part over the capital requirements that they set on these captives. Now, what happens when a state regulator sets lower capital requirements or competes over these capital requirements is that if a state has lower capital requirements, that's going to attract insurance companies to set up captives in their states, and it's going to have three main effects. First, it's going to allow the state to raise a lot of tax revenues. because insurance companies are going to pay taxes in their captives. And the second is that if you lower capital requirements on the insurance companies, that's going to make insurance prices potentially cheaper for consumers because insurance companies don't have to raise as much capital, which could be costly for them to finance. The third effect is that if you lower the amount of capital that the insurance companies are required to hold, that could potentially increase the default risks of the insurance companies. Now, this third channel of default risks embeds an externality. And this externality comes from the fact that the states that set the capital requirements on these captives don't bear the full costs of this default. And what I mean by this is it's because the states that set the capital requirements on these captives and have these captives only bear the default costs for products sold to consumers in their own states. So what this means is that the default costs are essentially divvied up amongst the consumers of the insurance company so that the remaining default costs, the part that doesn't belong to consumers in the captive state, are going to be borne by all the other states. So as you can imagine, this competition between regulators and this externality has become a major public policy problem. And there's been several proposals, including to eliminate or sort of restrict this kind of competition, and sort of more broadly in the context of federalizing insurance regulation have been proposed to potentially address this problem. And as you all know here in the audience, the US life insurance sector is an $8 trillion industry. So any kind of policy proposals here would have huge implications for the financial conditions of US households and firms. So what this paper is going to do is it's going to begin by just documenting some descriptive evidence of this competition and how it affects the supply of life insurance. And then second, it's going to develop a quantitative model of regulatory competition that I'm going to apply to the US life insurance market. And I'm going to use this quantitative model to be able to think about the effects of this regulatory competition. I'm going to find that competition between regulators lowers capital requirements that are set on insurance companies by about 25%. And what this means is that competition between regulators is going to increase default risks in the insurance sector, but it's going to lower consumer prices for the policies that they sell. And sort of the last part of the paper is I'm going to take these estimates and I'm going to think about it from a welfare perspective. So is this the case that the competition is actually sort of welfare maximizing or total surplus improving? What I'm going to show is that based on the estimates of the model, the regulators in the captive regulation appear to be too lax in setting their requirements relative to a total surplus maximizing benchmark. So what this means is that the competition between the regulators, right, which pushes, incentivizes them to set lower capital requirements, is going to exacerbate this laxness. So the competition pushes them towards setting even lower capital requirements when they already set capital requirements that are lower than the total surplus maximizing benchmark, so that this competition is going to decrease total surplus. So this paper makes three main contributions to the existing literature. The first is that it develops a methodology that allows us to quantify regulatory competition and its externalities. I applied this methodology to the context of the US life insurance industry, but of course the methodology, as you'll see, would be broadly applicable to studying other types of financial intermediaries as well. The second contribution is using this model, I'm able to think about cases where competition between regulators could increase total surplus so that it could be sort of beneficial, and cases where it could decrease total surplus. I'm able to decompose the different parts that attribute this total surplus to and think about their consequences. Finally, this paper is going to evaluate some heavily debated policies in insurance regulation, such as all the policy proposals that have been made on potentially restricting captives, as well as more broadly coordinating and federalizing insurance regulations. All right, So let me jump right into the institutional setting and give you a bit of background of captive insurance regulations. So I'm going to illustrate the example and the legal setting with MetLife as an example insurance company. So MetLife is an insurance company in the US that sells life insurance and other products to consumers in many different states. So as an example, let's take a hypothetical consumer that purchases life insurance in Massachusetts. And if they buy life insurance from Massachusetts, the Massachusetts consumer, once they buy a life insurance policy, the policy contract essentially becomes a liability from an actuarial perspective on MetLife's balance sheets. And this life insurance liability is subject to capital requirements, right? So for every dollar of life insurance that MetLife or other life insurance companies sell, the company is required to hold a certain amount of capital. Now, through the coordination of NAIC, you can think of these capital requirements as being effectively set uniformly across the nation. So in exchange for this capital requirement, this life insurance policy, this liability, is also guaranteed or backed by the state guarantee fund, right? So in this case, if it's a consumer from the state of Massachusetts, then the Massachusetts State Guarantee Fund is going to guarantee or back the insurance policy. So this is sort of the traditional or standard structure of insurance companies as we know it. Now, in addition to operating their insurance sales business, what MetLife can also do is they can also set up a special subsidiary called a captive. So a captive is just a special subsidiary that's set up in a particular state, for example, in the state of Vermont. And what MetLife can do with its captive is it can transfer its insurance contracts to the captive of Vermont. The transfer is formally done through a reinsurance transaction, but effectively the liabilities from an accounting perspective are moved off of the MetLife's original company's balance sheets onto the captive's balance sheet. So why does this matter? Why would MetLife want to do this? Well, the captive is subject to a potentially different set of capital requirements than its original operating company. So in this case, because the captive is based in Vermont, it's the state of Vermont that effectively sets the capital requirements on the captive. So why would Vermont go through the trouble of setting up and allowing captives? Well, Vermont is going to earn tax revenues. So for every dollar of life insurance liabilities that MetLife transfers to its captive in Vermont, Vermont is going to collect a percentage of that as a premium tax. So why does this matter? What does this mean? Well, let's think about two different states of the world. In the first state of the world, where we're in good times and MetLife is operating as normal and it doesn't default, Vermont is going to earn the tax revenues from the policies, contracts that are transferred to the captive. Vermont sets the capital requirement on the captive, and Massachusetts implicitly backs the insurance contracts, although because the insurance company MetLife is not in default, the guarantee fund doesn't get drawn on. In bad times, however, if MetLife gets into financial trouble and defaults, Massachusetts, right, where the consumer is based, is going to be on the hook to pay out the default costs of the insurance company, in this case, MetLife. Now, by contrast, if you look at the state of Vermont, Vermont is still going to earn this tax revenue, and Vermont is not going to bear the default costs on these captives. So it's this mismatch between the tax revenues, right, the benefits to the state of Vermont, and the ultimate bearers of this default cost that gives rise to an externality. So naturally, if you're a state like Vermont, or if you're any state, you would be interested in the business of obtaining captives, right? So what states end up doing is they end up engaging in competition for captives. So to give you a direct quote from the Vermont Captive Insurance Division homepage, they say that the mission of the Captive Insurance Division is to maintain a regulatory system that attracts quality business to Vermont. And of course, this competition is kind of widely acknowledged the industry. So an insurance company says that there's a healthy degree of competition, as states want to be sure they don't lose business to other states. So just to kind of summarize, from the state's perspective, what the state can do is it's going to lower its capital requirements, potentially to attract more captives, and that's going to give rise to several benefits and costs from the state's perspective. So if you're the state of Vermont, right, you're going to earn tax revenues from all the liabilities that are transferred to the captive, and potentially by lowering capital requirements, the insurance prices that your consumers are going to be charged are going to be lower because the insurance companies now have to hold less capital. The cost.
Can I just jump in with a quick question?
Yes, please.
Are the the regulations sort of per dollar of assets or per dollar of liabilities, or are they things like, well, you can hold your reserves in more risky, higher return assets, or like what are they actually competing on? Is it just basically the percentage of the policies underwritten, or is there something else that's, or maybe that just doesn't matter, so you don't need to answer it?
Yeah. So the short answer is both. Effectively, it's both the type of assets as well as the percentage. Yep. So the costs that the state faces from allowing captives is this default risk, right? If you're a state like Vermont, you don't potentially bear a lot of the default risks because you don't have a lot of consumers in your state. But if you're a state like Massachusetts or New York, you have a lot of consumers in your state. So potentially this default cost is going to look relatively large compared to the tax benefits that you may get. These are kind of the key benefits and costs that the states face when they compete for captives. Okay, so let me just kind of give you a bit of the lay of the land in terms of some empirical evidence of this competition. So I'm just going to first show you some results on the market share, if you will, of captives by each state over time. And then I'm going to show you some results looking at which states insurance companies actually choose to set up captives in, and sort of correlates of where which states tend to set lower capital requirements. And the sort of key takeaway, right, points 3 and 4 here are going to be that insurers tend to set up captives in states that have lower capital requirements for captives, sort of consistent with this idea that they're using captives to decrease the amount of capital they have to hold, and that the states are going to set capital requirements in a way that's consistent with this default cost that they face. So in particular, the states that bear less default risk are going to set lower capital requirements in the data. And then the last two pieces of evidence, I'm going to show some results on the effects of capital requirements. So I'm going to use a policy experiment that changes the capital requirements on products and show that when capital requirements are increased, the prices on the products go up and then the quantities go down. So that's going to kind of shed some light on how these capital requirements are going to change the supply of life insurance. Okay, so let's jump right in. So the first here, this plot, I'm just showing you the percentage of the market for captives that each state has since 2013. So here you can think of the market share as basically the fraction of all dollars that are transferred or reinsured from insurance companies to captives in each state. And what you can see is that in the US, at least, several states tend to be relatively large players. So Vermont is the largest by market share, followed by Arizona, Delaware, Iowa, South Carolina, Missouri, and of course, a collection of other states. Now, I should also mention that there are other captives that are not just in the US, so there are international or sort of Caribbean captives. I'm not going to study those just because I don't have the data on those, but those are also a potentially important piece of the puzzle. And then the other thing you can do is you can take these captives and you can essentially consolidate their balance sheets with their operating companies. And you can just ask, well, based on the reported amounts of capital and liabilities they have in their operating companies, if you add in the amount of liabilities and capital that their captives have, how much does their risk-based capital change? And the short answer is that it changes by about 25%. So this is one way of showing, again, that in the aggregate, these captives tend to actually be lowering insurers' total amount of capital. So that's kind of a couple pieces of aggregate statistics. Now we can also look sort of across insurance companies and across states and ask for each insurance company, right, and every year, where do they set up their captives? So what this slide is showing is essentially a choice linear probability model of, for every insurance company every year, there's a set of states that allow captives, and this is asking what predicts where insurance companies set up captives. So the main sort of predictor variable here is the capital rate, or the capital rate that is set by the state, which is just the amount of capital divided by the total liabilities they have to hold. And what you see is that there's a negative relationship. So what this means is that insurance companies are more likely to set up captives in a state that have lower capital requirements for their captives, sort of consistent with this idea that insurance companies are using captives for capital management purposes. Now, two things I'll point out about this analysis. One, it includes insured year fixed effects. So what this comparison is really looking at each insurance company, right, holding all their assets, liabilities, risk distributions constant, and asking what happens and how are they choosing between the different states. And the second point is that there are also other factors that could potentially affect where insurance companies choose to set up their captives, such as the tax rates in the states, the political environments, geography, or even sort of existing operations by the insurer. And all of those are sort of accounted for in this probability model, and capital rates sort of overwhelmingly are the first order driver in where insurance companies choose to set up captives. So capital rates really seem to play a central role in the way that insurance companies choose where they set up captives.
Sorry, again, just another quick clarifying question about that. So this relates to my previous question. That coefficient, presumably, you just told me that that the regulators are using other things besides the rate. They're also using the asset quality and stuff like that. Yeah. So presumably that's measured with error, and that means that this thing is actually biased downwards, like it's actually bigger than the effect is bigger than you say. Is that fair?
So what I also do is I also collect data on the types of assets they allow. In the case of the states with the largest shares, they actually all allow similar sets of assets. So that's less of a concern. Yeah. But yeah, it would be sort of a potential measurement error issue to consider. Yeah. Okay, so next, what we can do is we can just look across states, right? We can look across states and we can ask, this kind of default externality or default risk story, does it have any bite? Is it the case that the states that seem to bear less default risks are the ones that are sort of, strategically most aggressive in allowing captives and, conditional allowing captives setting lower capital requirements? So I'm going to measure default risk as just the amount of insurance policies that are sold in the state, which the intuition is just that if you're a large state and you have a lot of insurance policies and a lot of consumers, if MetLife or an insurance company defaults, you're going to be on the hook for a much larger portion than if you were a small state with relatively little insurance consumers. And so here in the first column, I just look at across all states whether the state allows captives, right? So a state has to pass captive laws, set up a captive insurance regulatory division. And what you see is that the coefficient here is negative, which means that the states that have larger default exposures, so greater default risks, they're less likely to allow captives, right? So this is kind of consistent with this default risk, default externality story. Now you can also look within states that allow captives, right? And you ask what capital rates are they setting conditional on them allowing captives. And when you see again here, the coefficient is positive, saying that the states sort of conditional on them allowing captives, the smaller they are, the lower capital requirements they're setting. So again, even on the intensive margin, there's this degree of how much a default risk or default externality that the states are internalizing. So hopefully this kind of set of evidence so far gives you a sense of what are the incentives that the states are responding to, and then also that these capital requirements really seem first order in driving insurance companies' choices. Okay, so the next piece of evidence I'm going to show is on the effects of capital requirements. So, what I've shown so far is that the insurance companies tend to respond to the capital requirements set on captives, and then states seem to be strategic in setting their capital requirements. And now what I'm going to show you is that capital requirements actually matter, right? They matter for the supply of life insurance, they matter for product prices and quantities. So to show this, I'm going to examine a policy experiment or a policy change in the early 2000s called Regulation XXX. So what Regulation XXX did was essentially it increased the capital requirements on life insurance products, but it increased the capital requirements more for insurance products that had longer terms, right? So if you think about term life insurance, the 10-year, 20-year, 30-year products, the longer term products were more affected by this capital requirement increase. So what this is going to motivate is I'm going to analyze this in a difference in differences specification, where I'm going to compare the product prices on different products sold by the same insurance company, but they had different effects based on the changes in the capital requirements based on this regulation. So the idea of this difference in differences comparison is I'm comparing two products sold by the same insurance company, and one of them was a shorter term life insurance product, so its capital requirement didn't increase by as much, versus another longer term life insurance product, for example, a 30-year life insurance product whose capital requirement increased by more. And I'm just comparing how the prices changed around this policy change. Oops. And here, what we have are the results. So here on the x-axis, I'm plotting sort of a one-year window of product prices around Regulation XXX. And the y-axis is the coefficient estimate. You can essentially think of the coefficient estimate as a percentage difference in price. So what I plot here are the prices on the term life insurance for products of different term lengths. So the one in light blue is 15-year, the darker blue is in 20-year, and then the black line is in 30-year, compared to the shortest term life insurance, the 10-year term life insurance product prices. The vertical line on the here, the vertical black line is the price, is the date of the Regulation XXX. So what you can see is that before Regulation XXX, these product prices were relatively constant, right? So this idea of the parallel trends assumption that this policy did not differentially affect these prices. But what you saw after, right, the policy experiment was introduced, or the policy was introduced, was that there's this immediate increase in product prices. And what you saw is also that the increase in product prices was monotonic, right? So relative to the 10-year life insurance, which is the baseline control group, the 15-year life insurance product prices increased, but the 20-year term life insurance product prices increased by more than the 15-year, and then the 30-year more than the 20 or the 15. So this sort of monotonic increase in product prices correlates with the capital requirement increases, again, sort of pointing to this idea that when capital requirements go up, product prices are going to go up. Now, if you sort of think about this in quantity spaces, right, to sort of further trace out this as a shift in the supply curve, you can also look at the quantity shift, right? So how much did insurance companies change in the share of products they sold? And here the x-axis is across product of different term lengths, so 10-year, 15, 20-year, 30-year. Again, sort of the Regulation XXX increased capital requirements more as your term increased, and the y-axis is the share of the insurance company's businesses that are of each product type. So again, you saw that as the capital requirements increased by more for longer term products, the share sold relatively decreased. So an increase in the prices and decrease in the quantities traces out a inward shift in the supply curve. So this is going to be really important because when we think about the effects of capital requirements on the aggregate outcomes in the market, the prices and quantities are going to be one key term. And this is going to be a piece of evidence in favor of that. Okay, so let me jump right into the model, and I'm going to spend the rest of my time talking through the quantitative model and the counterfactual policy analysis. So what I'm going to do next is I'm going to develop and estimate an equilibrium model of regulatory competition. I'm going to apply it to the life insurance setting. And what I'm going to do is I'm going to use this model to evaluate several counterfactual policies. So first, I'm going to think about what happens if we federalize insurance regulation. So we just had essentially a federal regulator that got rid of captives and set a single capital requirement for all insurance companies. And I can also look at what happens if the states enacted unilateral bans. And I'll explain more what that means in a second when I get to the counterfactuals. But basically, it's saying what happens if, for example, the state of New York forbids insurance companies from setting captives. And then lastly, I'm going to conclude by thinking about and looking at the distributional consequences across states. I'm going to show you that some states are going to be better off if we got rid of captives, whilst other states are going to be worse off. Okay, so let me just kind of give you a brief overview of the model, and then I'm going to jump in right into the results. So what this model is going to be, it's going to be a discrete time infinite period model, and it's going to be three types of agents. I'm going to try to match the types of agents that are important actors in this regulatory competition. So it's going to be state regulators, it's going to be insurance companies, and there's going to be consumers. And in each time period, in each of these discrete time periods, the agents are going to play a sequential game. So the sequential game goes as follows. In the first step, the regulators of each state are going to set capital rates on the captives in their state. And in the second step, the insurance companies are going to choose a state to set up their captives in. And then once the insurance company has all their captives set up, they're going to set product prices. They're going to set a single product price on the life insurance products that they sell. And then once the insurance companies have posted their prices, consumers are going to choose which insurance products to buy. And then lastly, after the consumers bought their life insurance, the insurance companies are going to draw some stochastic costs. They're essentially going to capture the amount of policy payouts that they have to pay out on their consumers' policies. And then once they've seen this cost, they're going to decide whether to continue operating their insurance company or to default. And this is how this default choice is going to show up in the model. All right, so let me give you a brief summary of the ingredients. So on the consumer side, I'm going to model this using differentiated insurance products where consumers essentially are choosing between differentiated insurance products sold by different life insurance companies. And this choice framework is going to follow a discrete choice logic demand framework, Berry 1994, which is commonly used in the IO literature to model consumer choice. Now on the insurer side, insurance companies are going to be competing with each other to sell insurance, but they're going to compete in perfect product markets. So they're going to engage in oligopolistic competition, which is going to give them some product differentiation and some market power. So in addition to setting prices, the insurance companies are going to choose to default, right? So they're just like any other standard corporate finance firms, and I'm going to model their default using a standard Leland default model, except they're going to be default choices are going to be sensitive to the capital requirements that they set. So as you can imagine, the sort of key intuition is that if the insurance company faces very high capital requirements, then it's going to be really costly for them to default because they're losing a lot of the capital that they would have been required to put down. So in addition to the default choice and the product market side, the insurance companies are also going to choose a state to set up a captive in, and then they're going to transfer or reinsure some of their contracts to the captive. Okay, and the last piece, right, is the regulatory piece. And I'm just going to spend just a minute thinking about the regulatory piece. So I'm going to start the regulators modeling their problem with that of a sort of a utilitarian social planner. Okay, so think about a social planner whose sole purpose is to maximize social welfare in this market. Social welfare is just the sum of total surplus, so consumer surplus, producer surplus, plus two other terms. It's going to be a tax and a default term. The tax term is just an accounting identity, which comes from the fact that the producer surplus, right, the insurance companies are going to pay out those taxes. So it's just a transfer from the insurance company to the government. So it adds back into the social welfare term. And then the default cost is going to be a sort of a social cost of default, right? If insurance companies default, we don't really like that because it potentially has real economic consequences for fire sales of assets, financial systemic risk, all that good stuff. Now, the second part, there's going to be two modifications to the social planner that I'm going to try to capture the realism of regulators' decisions. The first part is that even if you had a federal regulator, right, a federal regulator or sort of centralized regulator is not necessarily a social planner. And they're not a social planner in the sense that they may face sort of career concerns or agency frictions, right? So how I'm going to capture these agency frictions, I'm going to express them as these lambda weights that they're going to place on each of these terms of social outcomes, right? So for example, if regulators face political backlash, if insurance companies default, then you might think that they would care a lot about default costs. So one way to capture this is you would see this lambda default cost parameter being very high, right? So they would be willing to they care a lot more about default costs, so they place a lot of weight on default. Alternatively, if you think that customers complain, if the prices are too high, then you would think that maybe this lambda consumer term is going to be really high because they care a lot about consumers and their consumer surplus. So these lambda terms are just kind of ways of capturing how much the the regulator with all their regulatory frictions and incentives deviate from that of a social plan. And then the last modification is that, as we know, and why we're studying this topic today, that regulators in the life insurance are at the state level. So the last modification here is that the regulators are going to be at the state level, and they only care about the outcomes in their own states. So it's going to be indexed by the state index J. So each regulator in each state J is only going to care about, for example, the taxes in their own states, the default costs in their own states, and the surplus accrued to consumers and producers in their own states. So what does this capture? This captures a couple things. The first is this idea of competition. This competition comes in the fact that the insurance regulators can get tax payments from insurers in other states, right? So this tax sub J is accrued from insurance companies, potentially from other states that set up their captives in this state. The second is this idea of this default externality. And that comes from the fact that the default cost that each state bears is only on the contracts that are sold to consumers in their own state. So it's this default cost, default sub J. And the third thing to realize is that the state regulator is going to be able to change or maximize their welfare by setting capital requirements, right? So they're going to choose some capital requirements that's going to maximize the sum of these terms, but only the part that accrues to their own state. So every state regulator is going to try to figure out what capital requirement can I set on the captives that will maximize my own state's utility. And of course, if you add up the sum of other state regulators' welfares, you're going to get the federal regulator's welfare. All right. I think in the interest of time, I'm going to skip the estimation and calibration. Let me just talk to you a little bit about the data, and then I'll jump into the results of the model. So the data that I use is the standard insurance regulatory filings. For the balance sheets, I get data from their NAIC filings, as well as the SEC filings for the subset of publicly traded insurance companies. For product prices and quantities, I get them from CompuLife and S&P. And then default rates, default ratings, I get them from AM Best. So my sample for my analysis is going to cover 66 insurance companies from 2005 to 2019. And it's going to cover in total just under $2 trillion in liabilities. So it's about a quarter of the life insurance market that I'm able to match data to. And I won't talk too much about this in this talk, but sort of two key parameters in the model you can think of are essentially how costly it is for insurance companies to default from a social perspective, and how costly it is for them to raise equity capital. And these numbers I just take from estimates in the literature. Okay, so let me jump into the counterfactual policy analysis. So before I sort of talk through the actual results, let me just give you a quick piece of motivation. So hopefully, as you've seen by now, the competition between regulators has generated a bunch of policy debates. These debates have intensified a lot after the 2008 financial crisis, and kind of after sort of some state regulators have called for policy actions on these captives, both in terms of a federal ban as well as sort of unilateral decisions made by individual states. So what the model estimate shows is it's going to take essentially different capital rates that a federal regulator could set, or you can think of either a federal regulator or the states combined together, got rid of captives and set a uniform capital requirement on their insurance companies, and we can see what happens to things like default cost or consumer surplus. So here on the x-axis, I'm plotting the different capital requirements that the insurance companies, the federal regulators can set, and how default costs and consumer surplus change. So as you go from the left to the right, the capital rate goes up, and the default cost, which is a negative number in this analysis, essentially goes close to zero. So it's good. It makes sense in the sense that if you make insurance companies hold more capital, then they're going to potentially be less likely to default. The trade-off here is that the consumer surplus, right, is going to go down. So as you increase the capital requirement, that's going to lead insurance companies to set higher prices that passes through the cost of raising capital to consumers, and that's going to increase prices and decrease quantities, as I illustrated with the regulation XXX experiment. So what we can do is we can then ask, well, what would potentially a federal regulator do, right? So let's think about the lambda weights that I constructed with the regulator's problem, and let's apply them to these counterfactuals. So we say the regulator has some preference for default cost and some consumer surplus. Let's add them together. Let's see what point on this curve would the federal regulator potentially choose. If you add them up, you get a nice function where the regulator's utility is maximized at a certain point, right? So in this case, the regulator, and sort of hypothetical federal regulator, was set a capital requirement of about 16%. So what does this mean? It's higher than the current state average of about 13%. So what this means is that as you increase the capital requirements, which means you go from the state regulators to a federal regulator, you're going to decrease the amount of default costs, right? Because insurance companies are more capitalized. That's better for the insurance sector, but you're going to lower consumer surplus. You're going to lower consumer surplus by about $1 billion. So that seems to be making everybody worse off. And if you add these two together, right, if you're sort of a utilitarian social planner, you're going to add this $2 billion sort of improvement in default risks with this 0.9 billion in consumer surplus, and you're going to get an increase in total surplus of about 1.6 billion. So this is one way of saying that if we eliminated competition, so we moved from the state regulators equilibrium to one with just the federal regulator, that based on just eliminating captives, it would change total surplus and it would increase it by about $1.6 billion. So, if you sort of think about it at this point, if there's a potential increase from coordination and total increase in total surplus, a sort of natural question is, well, why don't states coordinate themselves? And what you can do is you can take the results from the previous slide and you can calculate the change in surplus by each state, right? So here, what I'm plotting is the change in surplus that each state would potentially accrue from either federalizing regulations or jointly coordinating and eliminating captives. And what you see is that on the y-axis, here I'm sorting the states by the size of their own state's insurance market, that there are quite heterogeneous distributional consequences across states. So in particular, if you have the large states like California, Florida, Texas, and New York, they would be the ones that potentially would benefit the most from federalizing insurance regulations, whereas some of the smaller states, in particular Vermont, would lose the most. Now, the reason why they would lose the most is because they have a lot of tax revenues at stake, right? So if you got rid of their abilities to attract captives and raise tax revenues, then their total surplus would go down because they don't gain that much from lowering default costs. And these results also seem to line up with the policy positions that have been taken on by these individual states. So if you look at the former New York DFS superintendent, Venlosky, in 2013, when talking about captives, he referred to captives as a form of financial alchemy and calling it shadow insurance, which puts the stability of the broader financial system at greater risk, right? So if you think back to the distributional consequences, New York is one of the states that would gain the most from getting rid of captives. Now, on the other hand, if you think about a state like Vermont, right, the Vermont captive commissioner, who I think retired in the last year, said that his hope was that Vermont continues to thrive as a jurisdiction and that it continues to create jobs for Vermonters about captives, and that he hopes that they continue to add taxes to their coffers and employ folks. So you can see that this kind of incentive, right, when it comes to the trade-off between tax revenues and default risks is very first order in the actual policy positions that the states have taken on. All right, so in the last few minutes, I'm going to show you one last set of results where we take sort of a less extreme of a counterfactual, right? So, for political reasons and for sort of other frictions, it may be very hard to get all the states to coordinate and federally implement changes. So given this lack of sort of federal cooperation, some states have actually proposed or implemented unilateral actions. So I'm going to consider two versions of this. The first version is what I call like a consumer side ban. So you can think of this as, for example, New York, right, which has a lot of consumers in their state. They don't want insurance companies in New York to use captives, so they just ban insurance companies in New York from using captives. That's what I call a consumer side ban. And then there's also a second version, which is a captive side ban. So you can imagine, for example, if Vermont, because of political pressure from New York or other states, said that, wait a second, we're no longer going to allow insurers to set up captives in Vermont because, all of these other states are giving us too much political pressure. And in some cases, there's also sort of histories of lawsuits of these states being sued for allowing captives. So here, what I'm showing you are the results from these potential sort of counterfactual bans. So the first bar is the effects or the change in default costs for the federalizing insurance regulation. So this is the baseline results I showed you a few slides ago, where essentially federalizing insurance regulations would sort of improve default costs by about $2.4 billion. Now, the second bar considers this consumer side, or like New York ban, and the New York ban is going to achieve part of the effect, right? Because New York is a large insurance market, it's going to actually improve default costs nationally by about 23%. So it kind of makes sense, right? If you have a bunch of consumers, there's sort of a large group of consumers, and you eliminated the insurance company's abilities to use captives for those consumers, that's going to potentially get you proportionally the way there with default costs. On the other hand, if you considered sort of this captive or supply side ban, right, with the Vermont, even if a single state like Vermont were to get rid of captives or no longer allow captives to be set up in their state, the effect is going to be relatively muted. So in this case, Vermont the effect is only going to be about 10% of the effect of federalizing, despite it having quite a large share of the national captive volume. And the reason for this, right? Why is this happening? It's because if Vermont bans insurance companies from setting up captives in their state, the insurance companies would simply move elsewhere, right? They can move to another state, and that's going to potentially lead to a sort of regulatory whack-a-mole problem where the insurance companies can just find another state that offers them the ability to set up captives. All right, so let me conclude. So in this paper, I documented sort of descriptive evidence of competition and its effects on the supply of life insurance. And then sort of motivated by these pieces of evidence, I developed a quantitative model of regulatory competition and applied it to the insurance market, where the competition is between state regulators and you have insurance companies choosing states to set up captives in. And then finally, I used it to the quantitative model to evaluate counterfactual regulatory policies. So what I showed is that if you federalize insurance regulation, that's going to decrease the total default risks in the insurance sector, but it's also going to decrease consumer surplus through increasing consumer prices. Second, there's also distributional consequences across states, right? So small states like Vermont would potentially benefit the most from captives. So if you eliminate them, then the small states would lose the most, but the states like New York would gain the most. And finally, the individual state bans, both in the case of New York and potentially in the case of Vermont, have relatively limited effects compared to a national federal action. So I think this idea of regulatory competition and captive insurance is very first order to the regulation of insurance companies. And this idea of competition and coordination between regulators also extends beyond the insurance sector. Right? It's also a central problem that we face in banking, environmental regulations, and health. I think there's a lot of interesting and exciting areas of future work, both in the insurance sector as well as in these other sectors as well. So thank you very much for everyone for taking the time to listen to this presentation, and happy to take any further questions.
Great, thank you very much. And I have Dan Schwartz first in line in the queue. So Dan, the floor is yours, and then Josh Teitelbaum after that.
Hi, so I really enjoyed this. One of the things though that I have a question about is that there are a number of sort of institutional details
Yep.
that seem to be missing from the account that at least arguably might impact the welfare analysis. And the biggest one is that typically an insurer is not going to be able to get any credit for ceding business to one of its captive reinsurers unless the regulator approves. And typically the state regulator requires a letter of credit from a financial company to back the possibility that the captive can't pay. Now, interestingly, the letter of credit is itself often then it's backed by a guarantee from a parent of the insurance company, so it gets very complicated. But I guess I'm just wondering how much we can rely on some of your broader analysis without taking into account at least that question of whether or not there really is default risk increasing, given the fact that many of the risks associated with liabilities being transferred to captives are backed by, at least potentially backed by, letters of credit issued by financial companies.
Yeah, maybe I'll answer this and then we can move on to the next one. So first of all, thank you for your question. This is a great point, and I think it touches on a couple of things that we talked about during the seminar. So on the first point about the letters of credit, I think it is correct that they're the captives have to be transactions have to be backed by a letter of credit. However, as you pointed out, they are sort of implicitly guaranteed by the parent company. So I think the sort of key economic sort of accounting is that the total amount of capital that is in the insurance company is potentially lower as a result of these captive transactions. And that's really the key economic object.
But that's actually not true if you think about them as separate entities, because the capital is of the parent is different than the capital of the insurance company. And so
I should clarify. The captive capital I'm thinking about is on a consolidated basis. So the total amount of capital is going down. Yeah. But I think it's an important question. I think it's an open and interesting question of like, well, how do you think about these default costs, right? So in the case of a default, is the financial institution going to come in and step in and actually pay, or is it sort of they're just going to let it go? I think that's a very interesting question. So I try to account for or think about sort of how the results would change if you kind of toggle those different parameters, but it's sort of a hard parameter to pin down. Yeah.
Great. So I have Josh, and then Peter Kotzenberger is next after that.
Great. Thanks, Peter. And thanks for this presentation. This is really fascinating. I guess my question is pretty simple. When you were analyzing why don't states coordinate, what you showed, your counterfactual estimates would say that the aggregate benefits to the winning states would far exceed the aggregate losses to the losing states.
Yep.
And these states, right, the transaction costs, it would seem to them bargaining here are low. We have the National Association of Insurance Commissioners. They're organized. It's an organized industry. It's easy for them to talk to each other. Why, if your estimates are right, why aren't they cutting a deal? So I'm just curious if you have any thoughts about that.
It's a great question, and there's something I'm trying to figure out too. So I can think of one reason why the transaction cost or sort of this cozy bargaining is actually sort of not costless. I think this, it really depends on the form of this, like what does cutting a deal mean? I mean, in the sort of purest sense, you would think of, New York would just pay Vermont essentially for the ability to not, set up captives. Now the question is sort of how politically, feasible that is. I mean, it's maybe hard to explain to voters that we're essentially paying off another state so that they don't undercut this broader system. But I think it's sort of it touches on the issue of, well, what is the nature of coordination and how do we kind of best think of an alternative regulatory regime that could efficiently solve this problem. Yeah.
Before I get to Peter, can I just ask you quickly, what is it in your model that prevents everybody from locating in Vermont? Like there must be, if it's the best place, why don't we have a Delaware kind of equilibrium or an almost Delaware equilibrium where everybody just converges on the place with the lowest capital requirements?
Yeah. So in the model, there's going to be idiosyncratic matching between the insurance companies and the states. And there's going to depend on the characteristics of the insurance companies as well as the characteristics of the states. So like an insurer might prefer a state that's geographically closer.
Okay, I mean, maybe by definition that has to be true, but it just seems a little implausible to me that, I mean, like the executives like skiing in the winter, so they pick Vermont so they can go, visit their captive and go skiing. I don't know. Anyway, never mind. Peter Kotzenberger, you're up next.
Oh, thanks. And thank you very much for taking the time to present this. So I think I have a better understanding now, but one question or issue is I mean, captives, I think traditionally were set up, and still many there, they're set up by large, particularly very large companies, now more middle-sized, largely for the tax advantages they can provide, which is my first thought, which is the most interested party in that is the IRS, who's been pursuing these actions for years. But if that fails in that arrangement, I don't think the regulator cares at all, other than reputational risk, because the policyholder is Microsoft or large, smaller companies, and that's simply a completely different issue. And captive insurance doesn't trigger, as far as I know, doesn't trigger any guarantee funds. So there's not the policyholder. But I think, and this is the question, I guess, you're focusing more on the indirect effects of captives being used as reinsurers, and then the life insurers accessing the effect on premiums. I think that's right, because there's a whole market of where that's not, they're not there primarily for reinsurance, but for the tax advantages that they bring for large and now middle-sized companies.
Yes, that's correct. So the captives I'm studying are the captives of life insurance companies. They're not of like Microsoft or other companies. Yeah.
Oh, I just had one other point real quick. I don't think it matters to the analysis, but the federal regulation of insurance, I mean, the last time I think that's been seriously on the table was 2010. I don't doubt it'll come back, and probably should, but it's not, things can change, but it's not an option that's really likely absent change, for a while. I think it was about 2010 was the last time anyone paid any attention to legislation. It didn't go far. All right, thank you.
Anybody else? Can I just ask one last?
Can
oh,
you
Walter,
hear me,
sorry.
Peter?
Nope, now I can. Thank you, Walter. The floor is yours.
I joined the queue. Johnny, a lawyer enters a conversation where there have been graphs and equations with some trepidation, especially the X and the Y. Siegelman's quite comfortable with this, but not so much me. What I wanted to ask you is, for a long time, captives were in the property casualty industry and not really in the life industry. And and I wonder if you've looked at this, in the 80s, some major life insurers went insolvent. One of the most famous ones was Baldwin United, because it was owned by a piano company. And after that, the life insurers looked strongly at should they support it? We, as me falling back my old role, should they support federal regulation, or should they do something else? And what they went for was strong accreditation with capital requirements and accounting requirements, and adopted by the NAIC, but not typical NAIC adoption. The state couldn't maintain its accreditation unless it adopted those capital and accounting requirements. So did you look at that? That's my first question. Did you really look at that and think about whether that worked? And the other thing to think about is it wasn't just a capital requirement. It was the pressure on the states to actually enforce and provide oversight for the companies. I don't know whether you've looked at what was going on in the 80s and 90s.
Yeah, so I think the part where I have looked at is, so actually the life insurers' use of captives in this current form actually took off after the regulation XXX changed that.
You're right. That's fine, and that's exactly so. It didn't. Accreditation worked to get uniformity through the 90s and into the early 2000s. Yep. So you're really focusing. Yep. Captives changed the. I mean, XXX and captives changed the deal.
Exactly.
And so the only thing I would comment, I don't think you could go back to accreditation again as a way to get this, as opposed to federal regulation.
Yeah, for sure. I mean, there's sort of the federal regulation, I think, is more of a catch-all to think about, okay, let's coordinate again. And, it's several.
Yeah, and then one last one, did you take a look at some of the insolvencies that occurred before there was accreditation or any of that?
So they are accounted for in the default probabilities that I use. So the default probabilities, I think, go back to like 1977, which is when I think AM Best first started collecting the data.
Yeah, you're fine.
But I haven't explicitly looked at them.
I mean, thank you very much. You answered the question, and this was a very interesting presentation. Thank you.
Great. Thank you.
All right, thanks. We got time for one more, and Dan has his hand up again. So Dan, the floor is yours for the last one.
Thanks. I have another question. So one of the narratives behind captives is that it's a sort of pressure relief valve from the fact that XXX is itself so terrible and so
Yep.
overly burdensome. I guess I'm wondering whether or not one interpretation of your results is that that's not accurate, that actually the underlying regulations, I think what you're doing in a sense is collapsing, actually arguably are efficiency enhancing because they decrease the default risk more than they impose costs. Is that a possible interpretation? And if so, how, or if not, how would we get there?
Yes. So one possible interpretation is that the captives, so if you undo the captive, so it's better to be in the world where we have everybody uniform than to be in a world where you have the operating companies subject to NAIC regulations and then the current set of captive requirements. I think it is a more interesting question that I'm not able to speak to, of like, if you like, what should the optimal level of federal capital requirements be, you know, if we were to uniformly undo everything. I think that's an interesting question. Yeah.
Well, okay. So I think our time has run out. I want you to join me, please, in thanking Johnny for a great talk. And if you have questions or comments, you can reach him by email. It's not hard to find him on the web. Thank you, Johnny.